Hello and welcome to my teaching of AP Macroeconomics Unit 2. Today we're going to be discussing what is College Boards 2.1, the Circular Flow and GDP model. So, Unit 1 of AP Macroeconomics is basically the same as microeconomics with basics of supply and demand. So I might discuss that a little bit later in the future, but we're going to start with Unit 2 here. So we start off with this concept of a circular flow model, right? So the idea is that money generally flows in a circle. So we have our houses. So let's write households, if I can spell. There we go. Households. All right. And then we have our our markets for goods and services. So market. I'll do a text box because I don't feel like writing. Markets for goods and services. So these would be things like stores and restaurants. If I buy a some food from my friend who works at a restaurant, I am buying some food from a market for these goods and services. If I am, let's say my friend is selling lawn care, that is the service, that is his market. We households buy stuff from these products for goods and services. Next, we have firms, which is a which is similar, but it's essentially an organization. Firm. So this would be like College Board or McDonald's or whatever. That is a specific example of a firm. And then we have our market for factors of production down here. So market for factors of production. Prod, PROD usage. Let's go. I can spell. Look at me passing kindergarten. So I think this is probably the easiest to understand from the household perspective because we are households. So we're going to start there. So we as people from the households will give our money. So I'm going to draw an arrow, and where the arrow is pointing is the direction of money. So we buy things. For example, buying a burger, we buy Sprite, we buy pizza. This is spending. Spending. I buy pizza from someplace. That is spending. And then I'll draw, I guess, a red arrow to demonstrate the flow of goods and services. So here we have whatever we bought. So like, I guess a good or service. I'll write that. Good. Well, I failed to write that. I had a really brilliant teacher tell me that to kind of describe goods and services, services, purchase, and like very plain English because we know what a good or service is from a young age, but it's very difficult to explain it. And what a a good is a noun and a service is a verb. And I never thought of it like that until my teacher explained that to me. And so now I'm explaining that to you guys. This is a very simple way of explaining it. A noun is, or a good is a noun, and a service is a verb. Baking, cooking, building, that is a service. A good, pizza, computer, clock, television. But let's continue with our fancy circular flow diagram. So then let's look at it again from the household perspective. What do we do as households? So we spend money, but we have to make money from somewhere. And that is where we get our jobs from. I work somewhere and I sell my labor to it. So here, this gets our income. Income. There we go. And then here we have, then we sell our land, our labor, and our capital. So we might give our lawnmower to somebody so they can work. You might sell your time. You might use a computer of your own that you maybe bought with your own money to help in these factors of production. So land, labor, and capital. Land, labor, and capital. That is definitely not what LLC stands for, so I'm gonna put commas. So when we buy a burger from a McDonald's restaurant per se, a local sandwich shop, we buy a burger. Where what happens to the money? Well, the firm, the corporation, the big boss man, the whole company gets money. That is what we call revenue. Revenue, Revenue, I think. I am not great at spelling, so this is might be spelled wrong. But the big company has to get some of these resources or has to do something to actually give the local sandwich shop its resources. So they give it goods and services. They sell goods and services. So the big company sells its little good or it sells its goods and services to the local sandwich shop for revenue. And that way the big company gets money. And then we put our factors of production, again like the land, labor, and capital, into the big corporation. And so now they get stuff to be able to create these goods and services. And this means that instead of necessarily money, they get wages, rent, and profit down here. So wages, rent, profit, whatever it may be. So you can see this kind of loop of resources and goods and services going one way, and you can see the flow of money going the other way. And if you ever forget, just think of households and what they do, and just then you can work your way around the circle from there. Now it is time to talk about GDP. And so you might have heard the term GDP before, but I'm going to give you the textbook definition. So GDP which is abbreviated for Y. I don't know exactly why. GDP is a acronym for gross domestic profit product, and they had to give an acronym to the acronym. I'm not really sure what happened there. So GDP or gross domestic product or GDP, which is abbreviated as Y. So GDP is the market value of all final goods and services within a country in a given period of time. So, and it's usually a year. So let me write up that definition real quick. So this is a very textbook definition. And so I'm going to walk through each of these components. So within a given period of time. So that would be like a year. Most GDPs are in reference to a given year. So GDP of 2022, 2019. That's relatively easy. So just usually on a yearly basis, or sometimes you might have the average GDP from like 2005 to 2010 or something like that. But again, it's generally within a year. Next, we have within a country. If I purchase something that was made in France by a French company, it does not affect the American GDP. If it was produced in France, it counts the French GDP and not any other country's GDP. And likewise, if someone bought something from America, but they were in Belgium, then it would count towards American GDP, even though it was not purchased in America. So many things we see are made in China. That's not affecting America's GDP, it's affecting China's GDP and not ours. And here's the tricky part, this final goods and services. So this idea is that you do not want to count intermediate goods. Think this is best explained with an example. If you have a card company that sells cards for Valentine's Day because I don't know, people like Valentine's Day cards. They're the modern trend. Okay, so people want to buy these cards and the store sells them. The card manufacturing creates these cards and sells them to the store so that people will buy them. Well, the card manufacturers have to get the paper and the ink from somewhere. So they buy the the paper from some other paper mart. But only the cards that get sold count to the GDP and not the the paper that was bought initially. Because otherwise you'd be double counting the cards essentially. You'd count the paper being bought and then the cards being bought. So if you had someone who just bought a bunch of stuff from a long line of people and we counted that GDP, you could see how that could skew the GDP. And then this is not a perfect measure because you don't know exactly if the kid who buys glue is going to use it for his art project or maybe he's going to create something amazing and then sell it for more money. And you don't know that. But this is the best we got. Now, before we get exactly how to calculate GDP, we're going to talk about what is not included in GDP. So this would be things like transfer payments. If your grandma got a COVID stimulus check for however much it was, that did not count towards GDP. It is the purchasing of a good or service and not just the transferring of money. If your Nigerian prince actually wire transferred you the $5 million, that does not count to either country's GDP because it is not a purchase of a good or a service. Similarly, stocks and bonds are not included in GDP because you're just kind of loaning them money and you're not purchasing anything from the company by investing in a company. Home services is also not included in GDP, and this one is a bit weird. If you have one of your family members just clean your house for whatever reason, you're just like, "Hey, can you clean my house?" And your family member's like, "Yeah, I got you." And they clean your entire house, then that doesn't count under GDP. But if you go pay the local maid service and you're like, "Yo, clean my house," and you pay them and they clean your house, that counts under GDP. So home services does not count under GDP. And used products. So if I buy a bike from 2006 from the neighbor's kid, then that does not count under GDP. The bike that he bought would count under the 2006 GDP, but it does not count under the current GDP because we would essentially be counting the bike twice and just in separate years. But we don't like double counting things. All right, now for how do we calculate GDP? So GDP or Y is equal to C plus I plus G plus NX. So we're going to go through each of these things. So the first is consumption. So if I purchased a pizza from a restaurant that was $10, then the GDP is now increased by $10 because we added to consumption. If I bought some cattle for my ranch, that would be investment because if they are helping me do something else, if they are working for my product or helping me be more efficient, it is considered investment. If I buy a computer, not for playing Fortnite, but if I was doing it for my accounting business or whatever, then that would be investment. So one of the biggest things that affects GDP is housing. But housing. So housing is a bit weird. If you pay rent, that's easy. You pay your landlord and you get a product. You get a place to live. That is consumption. You pay somebody and you get something in return. But when you pay for a house, let's say you're not living in it, you buy a farmhouse to kind of do stuff if you to work on a farm, but you're not living there, then that is investment because you are not living there, you are not consuming it. It just helps you with your cattle or farming thing. That goes under investment. But if you actually own a house, then it is like you're paying rent to yourself. With the other example, we saw that the home services, like cleaning your house, that would cost some amount of money, that didn't get counted. But we still add it to consumption here if you pay for your own housing with a mortgage. The idea is that they try and calculate how much you would have essentially paid in rent that year, and they add that to GDP. The they want people who pay for their houses to still get counted in GDP because housing is such a big point of the market or a big aspect of the market. So I guess I will like label these so I know what these are. But next up is government purchases. So that would be like the government said, all right, let's buy a road. Or the school district paid for a desk. Um, the government paying for a fire department or whatever. And you learn in microeconomics that the government gets this money via taxes. But we're not going to talk about that right now. And then we have NX, which is net exports, which is just imports minus exports. So, for example, if I sold a soda that was produced in the United States to France, then we would have an increase in the GDP from the net exports department. But if we said, I'm gonna buy a ruler from Taiwan, then our GDP would decrease because we have some exports. So try and figure out, I'm gonna do some examples. So I buy a car from this year that is $1,000. The consumption goes up $1,000. 1,000. All right. So that's the first one. Um, we buy a car from 2 years ago. That's also $1,000. So in this case, the consumption would go up $1,000 because we did purchase a car. But this came from our storage. So it is essentially also subtracting $1,000 from the investment. So there would be a net zero change in GDP. When you have if you create something like cars and you make 1,000 cars, but you only sell 800. You have 200 cars left over, and they go into storage. They go into your inventory, and so you can still sell them the next year, and but they will not impact that year's GDP. They will not impact the new year's GDP. They only impact the previous year's GDP. So if each car was supposed to be sold for $1,000, and we made 10 cars, and we sold 8 of them. Well, $800 or $8,000 would go into consumption here, and 2,000 would go into investment because we still have 2 cars in our inventory for that year to be sold in the next year. I buy a desk for my room. That would go under consumption. The desk is $10. I don't know what cheap desk I bought, but whatever. The desk is $10 that goes in consumption. Okay. The government buys a desk for a school, also $10. That would go under government purchases. Uh, we buy a I buy a desk made in China. All right. So here we have $10 in consumption because I buy a desk in America plus $10. But the desk is made in China. So it is not impacting our GDP. It will go to China's GDP. So there is a net change in zero GDP here. Obviously, GDP or even the GDP per a set of people, like a GDP per capita, does not always mean a country is doing well. There are many other factors that are not included in GDP that can determine some countries' well-being. This is their economic well-being. This is a good measure for it. But if a country has a really high GDP, but their lifespan is really bad, for example, they have really bad working conditions, but they make decent wages. So the GDP per capita would be pretty good. But the average life, if it's 40, that doesn't mean the country is doing very well. Or perhaps the high schoolers have the only 10% of this population goes to high school because everyone's working. As soon as you get out of middle school, almost everyone just joins the workforce. So maybe the GDP is higher, but the literacy rate is lower, or the percentage of students in high school or in education is lower. And so there's different factors of measuring how well a country is doing, and you can't account for all of that in GDP. But I hope this was enough. Uh, See you next time.